Hello everyone, welcome to my channel. Today I'm going to talk about what are debits and credits. Before I get into the video, be sure to subscribe and leave a comment below saying I subscribe. I will try to personally reply to your comments. The core of a business double entry accounting system is debits and credits. Money paid out of an account is represented by debits, whereas money placed into an account is represented by credits. A business firm's accounting ledger must record at least one debit and credit in equal but opposing amounts for each financial transaction it does. To balance each recorded financial transaction for various accounts on the company's balance sheet and income statement, bookkeepers and accountants utilize debits and credits. In a double entry accounting system, debits and credits are utilized to help the business balance its accounts at the end of each period. What are debits and credits? Debits, abbreviated as DR, are one half of a financial transaction recorded on the accounting journal's left-hand side. Credits, abbreviated as CR, are the other side of a financial transaction and are recorded on the accounting journal's right-hand side. Each financial transaction must have at least one debit and one credit, but there is no limit to the amount of debits and credits that can be used. The charts of accounts of a company aids management in determining which accounts are debited and which are credited for each financial transaction. In a financial transaction, at least two of the five main accounts must be debited and credited: the asset, liability, shareholders' equity, revenue, and expense accounts, as well as their sub-accounts, are those accounts. The asset and expense accounts are both increased by a debit. The balance sheet contains the asset accounts, while the income statement contains the expense accounts. A credit raises the amount of money in a revenue, liability, or equity account. On the income statement, there is a revenue account. The balance sheet includes the liabilities and equity amounts. What is the difference between debits and credits? When you pay a bill or make a purchase, the value of one account falls. Money is withdrawn, which is a debit, while the value of another account rises. Value is received, which is a credit. To decide whether to debit or credit a specific account, you must consider the following things. Assets has a debit which increase, a credit which decrease. Liabilities has a credit which increase, a debit which decrease. Shareholders' equity, a credit which increase, a debit which decrease. Revenue accounts has a credit which increase, a debit which decrease. Expense account has a debit which increase and a credit which decrease. Take this example. A business receives its monthly electric utility bill in the amount of $800. You would debit or increase your utility expense account by 800 and credit or increase your accounts payable account by 800. Utility expense is a sub-account of the expense account on the income statement. Those are equal and opposite journal entries. The accounting entry you would make in your accounting journal would be utility expense debit 800, accounts payable credit 800. Debits and credits will always be in adjacent columns on a page in an accounting journal. On the left, you will see debits, and on the right, you will see credits. Entries are made in the appropriate column for the transaction at hand. The difficult element is determining whether a transaction is a debit or a credit. T accounts come in handy in this situation. Accounting lecturers educate students how to record accounting transaction using T accounts. How do you record debits and credits? For journal entries, each T account is simply a list of accounts written in the shape of a T. Each transaction is recorded as a debit or credit for that account. This data can then be transmitted from the T account to the accounting journal. The T accounts for an electric utility payment, for example, would be debit the utility expense account. That will increase an expense. The credit will decrease an expense. Received the $800, that would be debited, and you paid would be credited. To determine how to treat an expenditure account, a business owner can always consult the charts of account. To accomplish this transaction, the other side's T account must be debit account payable, credit a liability account, decreases a liability, the debit, and the credit increases a liability, which is the bill due of 800. Now, when the pays the bill will decrease a liability. Now, asset accounts. Assets are goods owned by a corporation, such as inventories, accounts receivable, fixed assets, such as plant and equipment, and any other account on the balance sheet that falls under either current assets or fixed assets. Debit result in asset accounts increase, while credits result in asset account declines. Increases in assets are documented as debits in an accounting journal. Asset decreases are documented as credit. Here is an illustration. To prepare for holiday sales, a corporation purchases a huge number of inventory. Inventory is a current asset that is paid for with cash by the company. The business invests $10,000 in inventory. The entry in the journal entry would be inventory, debit 10,000, cash, credit 10,000. The inventory account is a type of asset account. It has increased, so it has been debited, and it has dropped, so it has been credited. Here is a tip for dealing with the cash account. The cash account is debited when cash is received. The cash account is credited when cash is sent out. The journal entry would be, if the corporation decided to sell a building for $250,000 and received cash for it, the journal entry would be cash debit 250,000, fixed assets credit 250,000. Cash and asset increase in value, causing it to be debited. Because fixed assets decline, they would be credited. Liability accounts. Liabilities are the debts owned by the corporation to third parties. They might be short-term obligations such as accounts payable and accruals, or long-term liabilities such as bonds and mortgage payable. The rule for liability and equity account is as follows. Increases are referred to as debits, whereas declines are referred to as credits. An example of a journal entry would be if a corporation has a bank loan and makes a $5,000 payment. Note payable, you would debit that account for $5,000 and you would credit cash for $5,000. Because the corporation made a loan payment, you would debit notes payable and the account would drop. Cash is credited because cash is an asset account that was depleted when the bill was paid with cash. Owner's equity accounts. The owner's equity accounts, like the liability accounts, are on the right side of the balance sheet. Common stock and retained earnings are two examples. When it comes to accounting journal entries, they are handled the same as liability accounts. An example of a journal entry for the owner's equity account is, for example, a company has two owners, one of whom want to invest an additional $50,000 in the company. The company's common stock is being sold at its par value. As a result, the final diary entry would be account name cash, you would debit that for 50,000. Common stock, you would credit it for 50,000. It's worth noting that when a company common stock is purchased, cash increases. Because cash is an asset account, an increase in cash is a debit while a rise in common stock is a credit. Expense accounts. Expense accounts are accounts on an income statement that are not linked to the sale of a specific product. Your list of expense accounts will most likely be the longest of all the accounts on your chart of accounts. Advertising charges, payroll taxes, and office supplies are all included in expense accounts because you will have so many. It's critical that you learn how to record precise diary entry for each. Here's an example of a commercial transaction with an expense account and the subsequent journal entry. A corporation pays cash for $750 in office supplies. As a result, a journal entry is created. The office supplies expense account is debited by $750 and cash is credited by $750. On the income statement, office supplies is an expense account, so you would debit it for $750. A cash account is a type of assets account. When you utilize an asset account, in this case, cash to buy anything, you credit it. Revenue or income account. On a company's income statement, revenue accounts are listed. The revenue of a corporation typically comprises both cash and credit sales. Investments can also provide money for a corporation. Larger corporations occasionally make investments in smaller corporations. Smaller businesses put their extra income into marketable securities or short-term investments. An example of a revenue transaction journal entry. Let's take an example. On a given day, a small business makes $5,000 in cash sales. The sales which generate revenue for the company would be recorded as follows. You would debit cash for $5,000 and credit sales revenue for $5,000. The revenue from sales is recorded as a credit. Credits are reported for increases in revenue accounts. The identical account is debited from cash and asset account. When there is an increase in an asset account, it is debited. The basic rules for recording debit and credits for the 5 accounts make up the enlarged accounting equation are covered in these steps. Finally, when it comes to debit and credit, the most important thing to understand is that a debit and credit must be recorded in equal but opposite amounts for each financial transaction completed by a company entity that uses double entry accounting. The business charts of account makes it easier for the owner to figure out what is a debit and what is a credit. Using T accounts and then converting them to accounting journal entries is the greatest way to learn how to record debits and credits. After that, the data from the T accounts is transferred to the accounting journal entry. Thanks for watching this video and do not forget to subscribe to my channel.